Remortgages. We've talked a lot about remortgages recently, but we haven't talked about remortgages with affordable housing. So what affordable housing is: right to buy, help to buy, and of course shared ownership. Now, what do you do when you've actually bought your mortgage? So you've got your mortgage, you've bought your property on one of those schemes. What happens when it comes to a remortgage? That's what a lot of people have been asking me. So I thought I'd do a video on it. So let's start with right to buy. You originally buy a a property with a right to buy mortgage. And what ends up happening is, as soon as you've bought the property, it's no longer a right to buy. You don't have any terms or anything like that. Now, if you're thinking of renting it, then you need to speak to the council, and there may be a period, normally 5 years, that you have to keep it as a residential, as in you living in it, before you can rent it. But if it's just a straight remortgage residential, i.e. you bought your right to buy on a 2-year fixed rate, and then you now want to remortgage it because the deal is coming to an end, then you can just go on any normal residential, and you'll find that the rates are better than a lot of the others. Because you're a right to buy, you have that option of having a low loan to value. So basically, when you bought the property under the right to buy, you got a quite significant discount, which means that when you now remortgage, what your mortgage balance is and what the market value is, there's a significant difference, and you can take advantage of that. And actually, when you do the remortgage, it will be a lower rate than some of the others. So in essence, normally it's like 20, 30, sometimes 40% of it was a discount. So say, for example, you bought the property and it was discounted by about 40%. That means that this bottom bit that you owe is about 60%. And if the property has actually gone up in value, it may be even lower. So what you want is whatever the lowest percentage of what you owe. So that's what loan to value is. So it's how much the value is, the 100%, compared to how much you owe. So do you owe, if you'd put down a 5% deposit, you would owe the bank 95%, because 95 plus 5. But if you got a 40% discount, then you would only owe the bank 60%, because 60 add 40, again, it makes up the 100%. So I hope that's clear. And if it isn't, please feel free to put some comments in, and I will come back to you and explain it in a bit more depth. So that's the right to buy. Next, shared ownership. So you can look at shared ownership in a couple of different ways. Now, when you originally buy the shared ownership, you will buy a portion of it. So a portion of it will be mortgage and a portion of it will be rent. But a lot of people like to do staircasing. Now, staircasing is when you buy more of the property. So say originally you bought 50%, and then in a couple of years you want to buy an extra 10%, and then a couple of years later you want to buy another 10%, and you keep on going until that 50%, you buy the extra 10, you now own 60%, you buy the extra 10, you now own 70%, and so on until you owe the 100%. Now, what you can do is you can go on a mortgage and you can buy the 50%, like I explained in the beginning, and you can get a mortgage, say a 2-year or a 5-year fixed. Now, if you go for a 2-year fixed, after those 2 years, you may consider borrowing more in order to buy more. So say the original mortgage that was going to last for 2 years and you owe 50%. And after those 2 years up, you now realise that you have a little bit more affordability. So, or the property is worth more, loads of different reasons why you can now afford more than the original 50%. So what you do is you look at doing a remortgage with additional borrowing, which means you use that additional borrowing to then buy more of your property. So you could buy an extra 5%, 10%, 20%. And as I said, if you buy an extra 20% and you originally owe the 50%, then because you own that 50% and now you're adding another 20, that means you'll remortgage and actually buy the extra 20%. So you will have a share, an ownership of 70%, and then the authority, local authority, or whoever you've bought the shared ownership with will have that 30%. So again, it all has to add up to 100%. The other situation you could be in is, and this is what I know one of my clients has done, which we had this strategy because she knew that she wanted to know what the rate was for the next 5 years, but she wanted the option of staircasing. So what we did is we organised a mortgage for her that was a 5-year fixed, but you could do additional borrowing. It's called further advance. Some lenders allow you to do it. So even though you're on a 5-year fixed, after 2 years, if you know you're going to be earning more money, then you can go work out your affordability and actually buy a higher percentage of the property. But you keep your original mortgage, that's the 5 years. But after 2 years, you don't remortgage that mortgage. What you do is you ask for additional borrowing. It's called a further advance. So the same lender, it has to be the same lender, will let you keep your 5-year fixed with them that, say you own 50% again of the property, but they will lend you additional money, providing on affordability you have to increase salary or whatever reason you've got more money to actually pay for this. Then they could lend you enough to buy another 10% or another 20%. So what her strategy is, she's got the 5-year fixed. 2 years later, she's going to do the further advance and borrow additional money to then buy 10%. And now she owns 60%. And then another 2 years' time, she's going to buy another 10%. So by the time the 5 years are up, and she remortgages, she has got one mortgage that has the 50%. She's got her first further advance, which is the 10%, and then her second further advance. So these are both additional borrowings. So they're like mini mortgages on top of the first mortgage. So when you go online and you're looking at your mortgage, you have got 3 mortgages with the same lender. One is for the 50%, one's for 10%, and the other one's for 10%. So you actually own now 50 plus 10 plus 10 is 70%. Now, after the 5 years is over, you would remortgage, but you would remortgage out of the one that has the 50%, out of the 10% one, and out of the other 10% one. So you'd be looking for a mortgage in order to pay off the 70. So the 50, the 10, and the 10. And then that way you'd have one mortgage for that. Now, the last mortgage that I'd like to talk about when it comes to affordable housing is the Help to Buy. Now, the way this works is you have 2 scenarios. You get a Help to Buy and it matches the time that the period of the Help to Buy ends, and you start charged interest, or you can buy yourself out, and a lot of people do that. So say it's 5 years, you get a 5-year fixed on that. When that 5 years is coming to an end, you remortgage, but you remortgage enough to borrow the money that you to pay off the money that you borrowed from the Help to Buy association, and then also enough to pay off your original. And then that way everything is on one mortgage and you're not paying interest to the Help to Buy. Or you could be in a situation where you got a 2-year fixed and you've still got another 3 years, for example, before you have to start paying interest on the Help to Buy element. So then when you remortgage at that point, you remortgage another Help to Buy product. The reason being, you are still on the Help to Buy. Unless you're going to pay it off, you are still on the Help to Buy scheme. So you remortgage with another Help to Buy product. But if you decide at that point you want to pay it all off early, then you can, if you're paying off the Help to Buy element and you're raising money, i.e. a further advance like we discussed previously, then you can go on a normal product, a non-Help to Buy mortgage. And the only way you can do that is if you are planning to buy out, so pay off your Help to Buy element. And then once you've paid it off, you no longer have a Help to Buy element. That's why you can go on a normal mortgage. So those are the 2 scenarios. And as I said, if you've got any questions about this, anything's a little bit confusing, please comment, send me questions, and I will happily DM you back and we can have a conversation, or I'll do another video to explain it a bit more. So please subscribe, add comments, share, and just spread the word, and I'd really appreciate it. Thank you.